Hello everyone, Prasad here and welcome back to my YouTube channel. In my previous video, I talked about the elections happening in India, my personal opinion about the outcome and its impact on the market. I'll link to that video in the I button, but in the comments of that video, I got a question about what is VIX, as I talked in that video about how the VIX is currently at 20 and it may fall to around 10, 12 once the election results are out. So the comment was basically asking what the VIX is and how it impacts the market. So I decided I'll make a separate video explaining what VIX is. So VIX is a short form for volatility index. What it does is the India VIX that you see by NSE is a measure of market's anticipation of volatility in the short term. Usually, market volatility often increases before big events like election, budget, or earning releases of the specific companies. Once the event is over, VIX falls as the volatility in the market falls. During moments of high market volatility, the share price or the market index like Nifty 50 may move sharply up or down. When there is a lot of anxiety or fear in the market anticipating sudden moves, the VIX tends to climb high during these times. So, if I have to give you a simple example, let's suppose that your 10th results are about to come out and you don't know what your percentage score would be. And you are very anxious whether you are going to get admission into science or commerce or arts and what your future is going to be. And it depends a lot on what kind of marks you get, whether you'll get a college which is near to your home, far from your home. So you're very anxious about your results. Once the results are out, your anxiety level decreases because now you are certain about the information of the result and you can then make decisions accordingly. Okay. In a similar way, VIX increases before a big event. Once the event is over, you know what the result is. The VIX falls after the event. Now coming to difference between a stock index like a Nifty 50 and a volatility index like India VIX. What is the major difference between two? So Nifty 50 is the stock index of 50 biggest market cap companies in India and is computed using the prices and weightage of those 50 stocks in the index. It takes into account the price movement of the underlying stocks like Reliance or HDFC Bank or all of those stocks. As the prices move up and down, the index also moves up and down. That's how the stock index is calculated, and volatility index moves up and down depending upon the level of anxiety in the market. If there's very high anxiety, volatility will be high, VIX would be high. Okay, so what is the importance of India VIX? So the major important part is that India VIX mirrors the state of risk among investors. When India VIX is high, the market accepts that there would be considerable shifts in the prices, indicating a volatile time. However, India VIX, if it is low, then market is anticipating very minor changes in the price. Okay. And for those of you nerds who want to know how India VIX is calculated and what is the background of India VIX and all of that, India VIX uses the Chicago Board of Option Exchange computing techniques. Basically, VIX is the trademark of Chicago Board, and S&P has granted a license to NSE with the permission from Chicago Board to use that trademark in the name of India VIX. And there's an appropriate modification done to adjust the VIX computation to Nifty options order book. So India VIX is computed using the best bid and ask quotes of the out of the money near and mid month Nifty options contract, which are traded on the FNO segment of NSE. I'll flash the formula on the screen here. So the formula used in India VIX calculation is as follows, and if you are interested in knowing more about the computation methodology and how it's calculated and all, I'll link to the white paper of NSE down in the description of this video. There they have explained the entire computation of India VIX using an example of 5100 forward index. So using that, you can understand how the VIX is calculated. Now coming back to the use of VIX in India for trading, and what are the market applications. Okay, now that you know how what VIX indicates basically and how it is computed, let's understand its market applications here. So when VIX is high or expected to spike rapidly, usually intraday traders face a lot of danger of their stop losses being triggered due to high volatility. Okay, as a result, if there is high VIX, or there's a probability that VIX might go up because there's a big event coming up, you should either not take excessive leverage, which was what I was talking about in my previous video, and stop trading or not trade at all during a period of such high volatility, or if you have to trade, then trade without stop losses or very deep stop loss, so that it is not triggered very easily. What I mean by that is, now this is not advisable for a seller, option seller specifically, but for an option buyer, if it's a very long term expiry contract that you are not trading a weekly contract, you can easily trade that long term expiry contract without keeping a stop loss. So you can, there's gap up, gap down, which might trigger your stop loss, or sudden movement of 100 200 points that can trigger your stop loss. All those events can happen during a high VIX phase. So in order to not do that, you can trade without a stop loss or keep a stop loss like very very low, so, or very very deep, so that it not gets triggered very easily. So that's one thing for intraday traders and option traders. The second market use is for long-term investors, but they are not usually concerned by short-term volatility because they are usually buy and hold. So not a lot of long-term investors are concerned by VIX. However, some institutional investors and proprietary desk may have certain risk and mark-to-market loss restrictions. So when VIX indicates that the volatility is growing, they may hedge their position in the form of buying call and put options against their own stock, stock that they are holding, so that they are hedged from any mark to market losses. Okay. The third application is that it's an helpful indicator for your favorite option traders. Volatility index is typically used to determine whether to purchase or sell an option. So if VIX is very high, then premiums tend to be very high. So it's a very attractive thing for an option seller to sell at such a high premiums. If you get low premiums, then your decay is low and your profits are low. But if VIX is high for a option seller, there are very good premiums available, so they prefer to sell during high option premium. And also for option buyer perspective, if VIX is about to go up in the future and you're buying at a low VIX, the increase in VIX will increase the premiums of your option. So if you buy in at low volatility and sell during a period of high volatility, you gain from the gain in the VIX. Okay. Coming to the fourth and final point, it's usually used for momentum based portfolio managers and mutual fund managers. Basically, VIX, when peak, they can try to increase their exposure to high beta stocks, and VIX when bottom, they can add exposure to low beta stocks, taking the benefit of the momentum that is in the market. So this is how momentum based portfolio managers and mutual fund managers use VIX. That's it for today's video. If you want to know anything more on this topic, do let me know. I'll try to come up with more videos on such topics. If you found this video useful, don't forget to hit the like button and subscribe to my channel to know more about such finance topics. Thank you. I'll see you in the next one.